Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is host Richard Benuli. Today we have Kevin Muir and Ira Harris. Long passionate about markets, Kevin grew up in a household where his father was an equity research director. Being exposed to market talk as long as he can remember, Kevin's true love was always macro. In fact, his first trade was in the US dollar index, which promptly went limit locked against him. but not deterred, Kevin persevered and got a job on institutional equity desk for a big Canadian bank in the 1990s. He then moved into a proprietary trading group where he was in charge of the equities derivatives book. In 2000, with a new young family and the desire to no longer work for a bank, he set off on his own. For the next 17 years, he would trade his own account, still does, with another former co-worker and a full-time computer programmer student they hired. Since then, Kevin has joined a well-established prop group. And Ira's independent trader, hedge fund manager, global macro consultant, trading foreign currencies, commodities, and equities for over 40 years. He also served as CME director, board director, Chicago Mercantile Exchange from 1997 to 2003, and a stint most recently. Welcome, gentlemen.
Well, it's a pleasure to be with you. And I must say, it's great to be with you, Richard, but it's a special honor for me to be with Ira. I've been watching Ira and reading stuff that he's been doing for many, many years. So I consider this a real honor to be on here with you guys.
Well, thank you. And I could give it right back at you. So, but this is what about, we have one done early this week. You know, again, hats off to the Financial Repression Authority out of Toronto. So again, I'm being beat up by Canadians.
That's right. Two of us.
I'm sorry. I'm sorry for the outcome of the Stanley Cup and what it's going to look like.
Oh,
all that. So now I know you're in a foul mood. Let's really go deep.
Okay, great. So thought we begin, Kevin, with your macro view on the global economy and the financial markets. How do you see the current situation?
Well, I've been saying that 2023 was the year that's going to both upset both the bulls and bears. It's going to be a lot of up and down with not much really happening. I was kind of not surprised, but comforted when I saw Stanley Druckenmiller the other day talk about how he was saying that his exposure is one of the lowest that he's ever had because he just doesn't see the ball, as he says it. It is a very difficult spot. Right now, we have a whole host of different confluence of different effects occurring into the market, things pushing from different ways that, and then the really big thing, the other problem is that we haven't seen this before. Everyone's using a playbook that they've kind of pulled up from either, 2006 or 2000 or 2018. They're applying all these kind of rules and just kind of standards and saying this is what's going to happen. And one of the things is that we need to keep in mind is that this cycle was nothing like any of the previous cycles. We had the government shut down the economy. We had the government tell everyone to go home. We had the government hand out huge amounts of checks. Now we have one of the largest kind of aggressive monetary tightenings that we've had. And we just have all these different things pushing back and forth. So one of the things is when I find people telling me, I know for sure that it's going to do X, Y, Z, I'm always like, hey, wait, let's be careful here. It's tough. This is uncharted territory.
Very interesting. Yeah, and your thoughts, Ira?
Well, I can't agree more. And I've been saying it till even I'm tired of hearing myself say it. We are absolutely in new ground. So when the yield curve inverts, yield curve inversions are something that you have to pay attention to, and I've studied them. and they've directed so much of my trading over life because they affect capital flows, and capital flows are so important to me in the way that I analyze my work. But I don't know what they mean with the Fed with an $8 trillion balance sheet, coupled with the $2+ billion in the RRP, and the banks and all types of lending institutions saddled with, as Chris Whalen has talked about ad nauseum, mispriced debt because they had to. They were forced into it, and yet you couldn't hedge it because the hedge took away whatever you were earning. So that made no sense. So why would you even put on the position? But here they are sitting in those positions, and we don't know. And I think Kevin's point is they're looking back to the 70s. The 70s, again, with Kevin, Richard and I did a podcast with Mike Every
Rabobank.
From Rabobank, which is
Yep.
really good. And we talked about, and of course, I'm not here to pontificate on things. I'm only trying to figure out how are we going to avail ourselves to make money
Right.
with this, right?
Well, yeah.
You know what? I don't want to be a political pundit. I just want to figure out the changes and see them ahead of time, and then look for the market action that'll say, okay. And it's exactly what Druckenmiller does. And right now he's trying to figure it out too.
Right. And the other thing that I think is interesting is that we have sentiment is so bad, and rightfully so. Like when you look at a lot of the data, and especially the soft data, the soft economic data, it is bad. It looks like the economy is about to head into a recession. Yet we've never had the divergence between the soft and hard data that we've experienced right now. And everyone's kind of, scratching their heads and going, why do we have this divergence? And you have really smart guys like the Morgan Stanley fellow, Mike, what's his last name? Mike Wilson. He says, the hard data always follows the soft. And he is right in all the cycles that we've seen so far. But, I really like Dario Perkins from TS Lombard, and he talks about it. He says this cycle is nothing like the previous cycles, and we have to be careful even calling it a cycle because it might not be a cycle. And I don't know what it's going to take to put us back on kind of a regular business cycle. And I almost would say that you think about the strategists out there, I think the best thing that they almost all are hoping for is that the economy rolls over, and then the Fed's able to lower rates, and then we actually go back into a regular business cycle. And Ira, you probably know, how many times does the market do something that's so easy and nice for everybody?
Oh, yeah, just, as my dear friend Norb, who I was just in Chicago, and they keep a desk for me just so I can come and sit next to him and we catch up. And he was always fond of saying, the market's job is to cause as much pain to as many people as possible in the shortest period of time.
Right.
And you know what? This market's doing a great deal of it. And I think that's why you're seeing, and Kevin, you're watching the very experienced global macro traders, because that's the world in which I reside. They're struggling with this because the ebb and flow and the headlines that drive such crazy movements. Here, classic yesterday, and I was in a room this morning where a friend of mine, Judd, who actually is on with Richard at times, and does really good technical work. And we were talking about the oil price yesterday with the Saudis. Right. I said, it's not that the Saudis say it. It's that the Saudis have a sovereign wealth fund of some significant measure.
Yep.
And they're all trading too. and it's like the old Solomon brothers with Henry Kaufman, where the bond desk would get Henry Kaufman's speech a half an hour before you would give it. Oh yeah. Believe me, I lived through those times. They'd position themselves. Henry Kaufman, who was, the bond
the original Dr. Doom,
and
right,
the keynote bond person,
right?
So they would position themselves. He'd start to speak. Back then we only had, who did we have? Reuters, Telerate, and the news was a lot slower. But they would start, and the market would, and Solly would unload their position.
Right. I recently wrote a piece about him because I was bringing up something about the kind of the the fact that we might be having a 1982 kind of episode in reverse. And one of the interesting things I found about him was that he actually was so popular that they had a national broadcast of his speeches that went all the way to Australia. It was worldwide. He was the original kind of, prognosticator that everyone loved to hear about.
Yeah, until the regulators caught wind of it, and then when Sally cornered auctions, which was a no-no, that edifice all kind of fell apart. But people would say, how do you know that? I said, watch the markets. Yeah. Somebody's buying or somebody's selling. He comes out to see, and then all of a sudden the markets. We are seeing this, to me, on steroids, because you have, and I'm not whining about it. We as traders just have to adjust to it. I don't make the rules. I wish I did make the rules. They'd be a little bit better, but so you see that, and the oil rallies, and I go, of course the Saudis are in. The Chinese are running sovereign wealth funds. The Russians run a sovereign wealth fund. Kuwait, everybody, and they're massive. Switzerland is nothing but a sovereign wealth fund, because the Swiss National Bank just prints money and does whatever the hell it wants to do with it, and to purchase hard assets. So it's
and just on that point, I always kind of wonder when I see these people, like Paul Tudor Jones or Stanley Druckenmiller will get there and they'll start talking about AI and they'll talk about how this is, so life changing and everything. But the reality is that by the time they're telling us about it, they're already long all these things. They've been buying for the past quarter. Yeah. So yes, put it into your equation, but be aware that you are not getting that information early. That is not when they're on CNBC talking about it. It's not because this is, the point where they're just starting to buy. This is the point they bought everything that they need, and now they're going to talk about it.
Well, and we saw that it's just, listen, Sam Druckenmiller was very open a couple of weeks ago talking about how he's building a short dollar position.
Oh, really?
Yeah,
I didn't know that.
Yeah, he's very bearish the dollar. So I said to people, don't go out and sell the dollar. Say, you don't know that Stan hasn't been doing this, and I have great respect for him. And I'm not questioning his integrity. That's on people. That's not on him.
Right. And he says that all the time. Don't do it because I'm doing it.
Yeah. Right. Because as I tell people, I said, your risk tolerance is not my risk tolerance. You better do your own work. Kevin and I and Richard, we can sit here and talk about things and thrash things out, which will make you think about these are possible good trades, but you have to figure out how it fits what your risk profile is. Otherwise,
completely agree.
Then you know what? Then they should drop a lot of money on you and I, Kevin, and I'll manage your money for you. I'll do that, but you're not getting it for free. And I guarantee you, that's the way a lot of other people, like when Paul Tudor Jones' wife, also have great respect. They're already involved in the trade. They're not. Yeah, I'm letting you all in so you can front run me.
Right. So recently, Kevin, you wrote about, speaking of rates and the Fed, a post in your Substack, of which I subscribe to. Great Substack.
Thank you very much.
It's called The Last Hike, ?
Right.
And just wondering if you could elaborate that. What are your views on the U.S. yield curve?
Sure.
Even why the 1 month is going, the way it is now, quite big changes happening.
Well, I guess we're only going to know in hindsight that was the last hike, but I just kind of, when we did have the hike last month, I thought to myself, okay, there's a good chance. A lot of smart people are saying this is the last hike. And I said, let's go back over history and let's look at what occurs in the various other asset classes at that point after it's actually not the case. If you look at it for another 6 to 9 months, it rallies. And speaking of Paul Tudor Jones, he was on CNBC recently, and he talked about that. He said, if you go look at the playbook and you say after the last hike, it rallies for about 6 to 9 months. And what you see is the stock market rallies, the bond market rallies, and, the dollar kind of goes sideways. And that was just the kind of point of my post was that, if this is the last hike, it doesn't necessarily mean the stock market's going to roll over. The other thing is we're in the third year of an election cycle, and there has never been a third year that is not finished up in the S&P since World War II, which is quite amazing because you think 1987 was a third year. And I always like to use 1987 as an example of things that people should keep in the back of their mind, because in 1987, the stock market rallied almost 40% from January to October. And the other interesting thing was, I can't remember the exact things, but the 10 years started at 7% and went to 10.5. So we had bonds like, crapping the bed and stocks rallying like nobody's business. And then it still ended up that the S&P was up slightly on the year. And obviously there was a lot of traumatic, there was a traumatic sell-off. But if you're getting bearish because you think this is setting up like 1987, be careful, because 1987 had a ripper of a rally beforehand.
How do you see the debt ceiling debate and discussions playing out and the effects on the yield curve?
For a while there, I was kind of saying that the market wasn't taking the possibility of a actual technical default seriously enough. And I think, though, that in the last little while, the market's become a little more aware that this is a chance. I don't, the trouble about talking about the debt ceiling is, let's say that we think that there's a 20% chance that they're going to default. And right now, the CDS market is saying that there is almost about a 4% chance they're going to default. So we could say, okay, the market is underestimating the chance of default. And we think it's 5 times what the market thinks. The trouble is that even if am correct in that the market is underestimating the chance of default, it still means 4 out of 5 times they're going to solve the problem. So we could talk about this, but it's an outlier event that they actually default. So one of the problems is that you have to be aware that, you have to think about your payoff profile. And like if I said to you, you're going to do a trade and it's going to pay off 1 out of 5 times, but you're going to make 10 times your money on that trade, then you should do it. But if it's going to pay off and it's only going to pay double your money, then you don't do the trade. And so it's kind of this trying to figure out what payoff profile you can do versus the odds of it occurring. And it ends up being a very kind of sophisticated, difficult trade for a lot of people to kind of get their minds around. Yeah. At the end of the day, they're eventually gonna pass it. Whether we have a TARP-like situation where they take it down to the floor and it fails, and then we have a big sell-off and then a rally. But we all know that kind of eventually it's going to get passed. And I think that if you were thinking about this as a long-term investor, what you should really be asking yourself is, what is the concessions in terms of spending that is going to have to be made to get it to pass? And everyone looks at 2011 and they look at the sell-off before the actual debt default problems. And there was a sell-off, but then there was an even bigger sell-off after it, post it. And the reason that there was that big sell-off was because the Tea Party extracted a lot of concessions out of Obama and the spending came in. So the economy was going to do worse. And then the other thing that we have is something called the TGA, which is the Treasury General Account. It's kind of like the checking account for the federal government. It's being drained. And when it's being drained, it's actually been pushing liquidity into the system. Once the debt ceiling gets raised, the government is going to go out and actually have to borrow a lot to replenish that. That will also be a situation that is liquidity draining and another risk-off event. So we could have a situation where if the Republicans extract a whole bunch of cuts out of Biden and then combined with the TGA, that it actually the resolution of it is negative for the stock market.
Yeah, that's interesting. Yeah, your thoughts, Ira?
So Kevin brings up good points, and let me just add a little more context to the 87, which I lived through as in its totality. And what drove those interest rates up, which he talked about, was the Germans acting against what they had all agreed to, the Louvre Accord. Because in 1985, of course, in September with the Plaza Accord, which drove the dollar lower by G7 coordinated action. Well, they figured that the dollar had gone too far, and by March of 87, they agreed to a Louvre Accord, which was that the United States could raise rates, but everybody else would hold theirs regardless, so that we can get a semblance of rebalancing in the financial system. But of course, August, September of 87, the Germans say, now we've got too much inflation, and they start raising rates, which then forces the US and others to raise rates. And it left Japan holding the bag, which is why we get the massive bubble in Japan, because Japan adhered to it, but everybody else was forced into breaking away from it.
Right.
So Japan really got saddled with that. Just add a little context with that. But with everything else that Kevin is saying, I can't agree more. And there's been a tenacious little reporter at Bloomberg who has been writing about this probably better than anybody, Alexandra Harris, who I happen to know quite a bit, being that I birthed her. Well, I didn't birth her, but my significant other, but she's been all over this and talking about when they do bring this, what it's going to do to the T-bill market and to the Fed funding market, which is going to be important because the Treasury is going to have to sell $1 trillion, $1.5 trillion of new Treasury bill. You know, my only concern about the Treasury bill market is why the CME hasn't listed a Treasury bill contract again, because there's no Treasury bill futures contract. There's SOFR and there's Fed funds. But I think and I argued over the years past that when you could see the debt exploding, it was probably time to bring back the Treasury bill contract.
I never thought about that. That's a great idea. And especially in this day and age where it's all electronic, it can be done so easily.
Yeah, so easily. And there's a ready market for it. I mean, it's huge. And it fits even retail investors because there's a lot of retail investors who opened up T-bill accounts at the Fed. I know because a lot of people who sought my advice, you know, after 2021, they said, I said, start laddering short-term interest rates.
Right.
Because I said, don't listen to what the banks are telling you. Because if you're bullish the market, the long end of the curve is not going to stay here. So you don't want to do something in which you have capital risk. So stay short term and just keep rolling them. You know, if you buy 3 months, I know you're getting nothing and you're getting a little bit more. But I'll tell you what, had I sat on Silicon Valley's board, I guarantee you that portfolio with any thinking board member would not have been in that situation.
For sure.
Right? Because
I
mean, it's the same advice that you give to people that, now how does it play out? Just like we started, Kevin, I have no idea. I have no idea.
Yeah.
I have no idea. You know, and it's not binary. This whole concept that Wall Street wants to push out on people, it's either pause or cut.
Right.
No. Yeah. You know what? We could sit here and Mike Every, we talked quite a bit, and even Posar, I reread that little, Alex wrote the piece May 5th, because all of a sudden Zoltan showed up. He's been kind of MIA for good reason.
Right.
As he's trying to, and I say that with great respect, because I have nothing but great respect. Whether I agree with Zoltan all the time, doesn't matter. He sure makes you think about things.
For sure.
And you better put that into and think about it. Well, when Posar talked about, and the title of the article, I do have it, was that that the Fed in reacting, that they're quick to react, and he respects that, like with the banking crisis, but that'll keep them holding rates longer. It's not cutting. I mean, why can't you sit here at 5%?
Yeah.
Right? 5.25%. Now, an interesting piece, Kevin, I don't know whether you saw this. It was sent to me by one of my favorite people, Kevin Waspy, a professor at the University of Illinois in finance. And I've lectured for his classes over the years. But he sent me a piece today, and I'm sure it came from Liberty Street Economics.
Okay. Yeah.
So they have a piece out today called Measuring the Financial Stability Real Interest Rate, R2-star.
Oh, yeah, I saw that.
Did you see that piece?
Yeah. I didn't read it. I did see it because guys were joking about like R-star wasn't bad enough. We have R-double-star now.
Except when you finish with it, take a look at it, because there's a chart here called the financial stability rate versus the real Fed funds rate.
Yeah.
And that's an interesting chart. And I think reading you and knowing enough about you, that when you get to zero real yields, the dynamic generally changes,
Oh, yes.
right? Especially when you've come from a steep negative real yield.
Right. Yep.
Now, I'd say we're pretty close to zero. Whatever metric, I don't get into conspiracy. All I can do is deal with the data that most of us have to deal with.
Well, I think tips are actually positive. We're actually positive. And one of the other things that I thought was interesting is that kind of one of my pet peeves is that everyone talks about inflation and they use these year over year figures. And I'm like, that's kind of a ridiculous thing to be using, because like you have, let's just take the last 11 months are built into there when you're looking at this next month. And so we have this situation where people go, inflation's 5%. And I'm like, inflation's not 5% right now. And if you actually look, John Williams did a speech with the Wall Street Journal guy, Hilsenrath, and it was an interview. And it was a terrific interview because he says what you really should be doing is looking at Fed funds, or maybe even forward kind of, 6 month or 1 year forward Fed funds, and comparing that to 1 year inflation expectations, because that's probably where inflation's going to end up being, right? So if we go look at 1 year inflations, they're, 3% right now.
Yeah.
And meanwhile, Fed funds are 5.25. So really, real rates are positive 200 basis points.
Yeah.
And Powell said that at the last press conference.
That's right.
Exactly that. He said
Yes,
the 1 year, and I know it because there are inflation expectations, but then it begged the question, well, why didn't you pause?
Right. Yes. I think he was too scared. He was too scared.
Well, you know what? They gave into, and that's that terrible forward guidance, is because you had Richard Clarida come out, and before that, at the previous meeting, you had Larry Summers all over the place telling, well, if you don't raise rates, the markets are going to think that there's something greater wrong here.
Yeah, I know.
So you got to raise rates. You know what? As my grandmother, my dad's mother, may she rest in peace, she'd have a word for it. She said, what a cockamamie idea that is.
Oh, yeah.
That you're setting policy based on that.
I think they shouldn't be saying anything. They should just set policy and then let the market figure it out. I think all of their communication is just making things way worse. And I think all you have to do is go back to the Silicon Valley thing. People took them at their word, and now they're saying, oh, look, you told me that the inflation was going to be transitory, so therefore we did it. You shouldn't be listening to them. They shouldn't be giving any sort of guidance. They should just be setting the rate and saying, we're going to assess situations next month, and we'll decide the rate then.
Yeah.
And anything can happen.
Right. And I'm sure we'll agree on this, because I've talked about it with many others. The worst mistakes in U.S. central banking history, I might add, was Bernanke's taper tantrum in May, June of 2013.
You think so? You think that was the worst one?
Yeah, because, well, there's many to go with it.
Okay.
But he was on the path of doing something to adjust all the, everything that he poured into the markets. And as soon as the markets had a little tantrum, he caved.
Yeah.
And had they proceeded on that path, with COVID, but we would have never seen the balance sheet grow to that extent, and they would have been shrinking it, and the market would have taken its time to sort through this. But when he caved into Wall Street, which is what the taper tantrum was all about, they knew that they controlled the game.
Right. And I could say that I looked at when Powell came in 2018, when he first took over, he was very hawkish. He started talking about, if you remember his initial speeches, he's like, we have to burst the bubble because cleaning up the bubble afterwards is more expensive than bursting it ahead of time. Right. And then we had that Christmas massacre in 2018, when the market went no bid, and he panicked, and he completely did the same thing Bernanke did with the taper tantrum. And then what really makes me mad about Powell, and I listen, he's a human. He's juggling a lot of different factors and a lot of different, constituents trying to push him in different ways. So, those in glass houses shouldn't throw rocks. But if I am to get mad at what I'm disappointed in him, it is in his inability, his flip-flopping. Meaning that, so let's just take 2018. He comes out really hawkish, and he's going to be this hawkish guy. He's going to do it. So that's fine. If he had stuck with it, the market would have adjusted. It would have figured it out. We would have done it. But then he gave in. Then we had the 2019. And you remember when he started talking about, I can't remember inflation, but maybe actually it's after COVID. So COVID comes and he has to do what he has to do. I'm not going to judge him at all for that. He's doing what he has to do. But then remember he started talking about flexible average inflation targeting.
Oh, Jackson Hole 2021.
Yeah. So he's talking about flexible average inflation targeting. He's talking about minority unemployment targeting and things like that. And those are lofty goals, but I'm not sure that they should be done by monetary policy. They should be set by, that should be a fiscal policy that you're trying to do. You shouldn't do it with monetary policy. So he's gone from being a hawkish central banker in 2018 to probably, I would argue, the most dovish central banker that we have ever had. 2021 was the most dovish that we've ever had. Everyone talks about Yellen. I think Yellen was nothing compared to what Powell was. So he goes from being this super dove. And then what happens is all of a sudden inflation comes back. And we can talk about why that is, but he blows it. He doesn't have the guts to actually raise rates while he's doing QE because he says that you can't be pushing and pulling. And it's like complete bullshit. We all know that that was just a plumbing thing. It could completely have been done. He could have done the last, 3 months of QE while he was raising rates. There was nothing stopping them from doing that. So he goes from being hawkish to dovish, and now to being the second coming of Volcker again. So he's just flip-flopping too much. And I think that that's really what's causing a lot of the problems in the markets and even in the economy. I think he's created way, way more volatility in the underlying economy than necessarily needs to be the case.
You know what? So Richard, I know you're going to get.
No, go ahead. Yeah.
Let me just. I can't agree with you more, and we'll return to our good friend Stan Druckenmiller, who in 2018. Now I can tell you this. I was on with Rick Santelli in July of 2018. And he had purposely off the cuff asked me about what the Fed was doing. I said, Rick, I would have raised rates to 2 or 3% immediately, one swoop, and then I would have spent the rest of the time draining through quantitative tightening all those reserves. And let's find out. We just don't know. We've never been here, and admit that we don't know. And then when Druckenmiller came out in December and criticized the Fed before the Christmas pivot, but Stan's words, and I know him well, he said he's made a mistake using a double shotgun approach, raising rates.
That's true.
While quantitative tightening.
Yes.
And he should have gone to the one, stopped, and then. But I think Powell is a very bright guy, but he's captured by the sea of academics that he works in.
Right.
And I agree with you. And it forced him. And Richard and I have done many podcasts about this. So I was already referring to him back in 2020 with COVID. He became the Minister of Social Justice. Now, I'm like you. I'm not going to argue about the outcomes.
Yeah.
That people have jobs. I'm not, but I don't want my Fed chair to be a social justice minister.
Right. Can I just, Richard, one just quick little comment about that, because you talked about the reserves, and I actually thought it was interesting that Jamie Dimon was just on. If you looked at when he gave, I guess what was the JP Morgan's annual kind of meeting, he talked about the reserve, the RRP, that $2.25 trillion thing, and he said, "Listen, we don't know what's going to happen with this." And he's echoed very similar thoughts to what Ira is saying about this draining of reserves, and this RRP is more dangerous, and we should be more kind of worried about this than we are.
Yeah, he's worried about that. Yeah.
Yeah, that's a very good point.
Yeah. And what about how does this all play into the currency markets? Any thoughts on the US dollar, trends thereof, or other cross currency rates like Japan?
Sure. I am a US dollar bear, and I'm not a US dollar bear because I think the US dollar is going to lose its reserve status, or there's going to be some sort of de-dollarization. I'm not one of those fellows, but I do believe that the past 20 years, the US has been the market for everyone to own. And there's a variety of different reasons for that. I would argue that they had the highest real interest rates. They had the most aggressive fiscal policy, and also the combination of the tech being kind of the sector that was the most attractive.
Yep.
So if you were someone that was managing money as a pension fund in Europe and you weren't overweight US assets, you don't have a job anymore. Like it's been the only place to be. US financial markets have absolutely crushed everything else when you look at the longer term.
Yeah.
So like all things in the markets, a good thing turns into, like everyone gets into it till it becomes a bad thing and it just gets overpriced. So I look at it and I think to myself, everyone is overweight US assets. The market is on a relative basis the most expensive. There's some problems occurring. I think there's also going to be a shift in the type of stocks and things that you want to own. And meanwhile, you can go buy things like Europe at a cheaper multiple. You can go buy Japan. And so I think about it and I'm just like, the US dollar is just going to be at the margin. It's going to be for sale for many years, maybe even a decade. And it's not going to be that there's anything that wrong with the US. It's just going to be a return to benchmark weighting for a lot of other kind of foreign asset market players.
Mm-hmm. Yeah, and even speaking of Japan, Ira, your thoughts? I think you were bullish on Japan banks.
Oh, I love Japanese banks.
Japanese banks also, yeah.
But
so cheap.
And 6 weeks ago when we were on with Rosie, another Canadian, David Rosenberg,
Yep.
who we enjoy, and really and he too was very bullish. But Louis Gavay and I had this discussion back in January on these podcasts and a year earlier, because Louis had some really interesting views, and I think that they've really borne out. And I think the Japanese stock market is phenomenally cheap,
Yes.
Especially in relationship to the yen. Japanese multinational corporations are killing it. And, this is no small thing in my mind. Japan is ramping up defense spending. Now,
oh, yes.
The Japanese are very good at re-engineering high-end products, optics, automobiles, we certainly know. So when they really get into the defense business, if I was the U.S. defense, I would start to move out of U.S. defense stocks. I don't own defense stocks, and that's not. I don't own defense stocks because that's the decision I made. Because to me, well, you're from Canada, so you're in the land of the maple leaf and peace. But and I'm old enough to know where that border was, just in case I had to. My lottery number was a little lower. So Canada, well, but the U.S. defense industries have had certainly an oligopoly. I would probably argue a monopoly, but that's going to change as we are now seeing some people, and you're going to have the Germans enter into the defense realm in a way that they haven't, under the guise of their own security deals. So that makes me even more bullish Japan, because we just saw it with Micron when they announced that they were moving a plant. So there's going to be, and that's why we were originally as bullish as we were, with Rosenberg was the same, and Lewis, that there was going to be a lot of onshoring and shifting to Japan, and especially to avail yourself of the weak yen.
Right.
And the yen is phenomenally weak. Now, I would, at the G7, if I was there, I would have argued with Kishida and the Minister of Finance, and certainly Ueda, hey, you can't keep running this policy.
I know the YCC, the yield curve control. That's the thing I was about to say, is that the reality is that everyone else is doing quantitative tightening, and for all intents and purposes, because of yield curve control, they're expanding their balance sheet. So no wonder their economy is going like gangbusters. No wonder the yen is cheap. It's they're running hot, and if they're running hot, then you have to own the equities.
And the BOJ has, everybody talks about that they own JGBs. They own a whole lot of equities via REITs and ETFs, because they've been buying, because don't forget, from the get-go, they did QQE, quantitative and qualitative tightening. Easing. I'm sorry, easing. So they've been buying equities, almost like the Swiss National Bank. We don't know quite what that balance sheet looks like, but with the TopX making 33-year highs, the Bank of Japan is sitting in a better position than a lot of people realize. And everybody's just focused on, but wait a minute. See, that's why that 2% inflation target drives me crazy.
Yes.
It just drives me crazy. And I hold him in the highest esteem. Paul Volcker was totally opposed to a 2% inflation target. He understood it, but he thought it was terrible.
It's made up. It was done. It was a New Zealand central banker picked it. They asked him on. They asked him on TV or something, and he just picked it up, and then everyone did it. Speaking of Japan, by the way, for those that listeners that are wanting to buy different names, you can't buy the ETF of the banks in US, but there is 1615 on Japanese stock exchange is an ETF of just the banks. So that's one of the ways that I played it. And then the other thing that I did when Buffett went way back when, and he bought those 5, he calls them trading firms. I don't know. They're kind of conglomerates. I bought those with him, and I just kind of closed my eyes, and I still think you buy those things. So I have the 5 numbers, and it's kind of strange buying when you buy a stock and it's not a symbol, it's a number. But it's been a terrific investment. And I saw recently that Buffett and his number 2 guy went out there and they're expanding. And I think that it's a great long-term trade that people should definitely look at.
Yeah, he started buying them, I believe, in June and July of 2020. Right when COVID and all of a sudden he announced that he was buying the Japanese big trading companies. Now, that was more than a passing interest. So, and I as a stupid investor, but Japan is something I know quite a bit about. I've studied a lot about it, and I watch it because I think it's a very important element. And I've owned, I got rid of Mizuho, but I owned Tokyo Mitsubishi for 8 years. And it's you want to talk dead money, that's dead money. Shame on me, except that it's paid a 4% dividend over that time. So it's like owning a bond. Right. And I knew they weren't disappearing. But if the Japanese story becomes real, I think the big banks will be a pretty good barometer of what's really going on underneath it. Because
that's
they've
a good
been
point.
so dead for so long. And yet Asia is an interesting story regardless. Yes, China is China, and we're trying to figure that out. But I agree. So in Europe, it's always hard for me to move into, but I've actually been buying, I don't own any US banks, but I bought, and I've talked about it many times on the podcast. So I've looked at Commerce, and I've been in UBS. Because UBS, I actually bought in May and July of 2020, because I saw the shift. And I know Axel Weber was on the executive board, which tells me a lot. And Commerce is going to be led. Now, Commerce is interesting. Now, I know they're garbage, and they've been trying to do the Deutsche Bank Commerce merger probably before you were born. They thought it was a really good idea. They could never bring it to fruition, but I started buying it probably almost 2 years ago, because I started paying attention, and Cerebras, who I'm not a big fan of, owned like 10%. They have since sold 5%. But the one who's, I think in June begins to lead Commerce is Jens Wiedmann. I'm pretty sure that that's right. So somebody who listens, but so Wiedmann is, and they're in a interesting place only because if you get a Euro bond ever, which is part of Europe's problems, and Lagarde has to deal with always the threat of fragmentation of all the different sovereigns. But if you get a Euro bond, you're going to get a broker-dealer system in Europe for the first time.
Okay.
And according, when I read the ECB a few years ago about it, that's what made me look at Commerce, is they said you'd have to be domiciled in the EU.
Right.
So they didn't want Goldman,
Yeah.
Morgan Stanley running this from either London or New York. You're going to have to find a way to get domiciled so they could have regulatory authority, which is
Right.
pretty intelligent. You know, why would you do it any other way?
Yeah.
So then there are certain banks that are sitting out there that become, to me, very interesting.
The other thing is you can buy the SX7E future, which is the kind of the Euro stocks bank future. And I like that. That's one of the things that I play. Like I just go and buy that future, and it's a great kind of contract. It ends up being a little small, so you have to do a lot of them, but it's super liquid and it's great.
And we're not telling you to run out and do these, by the way. Go do
No, for sure. Just if you're interested, have a look, and this is something you can have a look at. And
yes, absolutely.
Yeah.
Absolutely.
And you mentioned we were talking about onshoring to Japan. What are your thoughts on Mexico? I think you also mentioned that in your writing.
Yeah, I love Mexico. I think Mexico,
Okay.
if you think about it,
Yeah.
China came along and basically Mexico was the workshop of the US back in the 80s or in the 90s. And then China came along and stole it from them. And so what we have now is a situation where we're going to have what they call friendshoring. And it's kind of just the reality of the new world order that we're in, is that the globalization is going in reverse. We're going to, whether it be the supply chains, the fact that the world's becoming a little more, there's more conflict out there. So we're going to have deglobalization. And so what you're going to see is things like Mexico, Canada, and the US as getting together and doing this friendshoring. And I think that Mexico is going to become kind of the workshop and do what China did for, for the American companies. It's going to go to Mexico. It's dirt cheap. And there's lots of problems with it in terms of, they had political issues. But apart from that, it's just everything's going the right way. And we're going to have a situation where there's going to be growth there for a long, long time. You can go, real rates are really high. You can buy the currency. I own the currency. I own the stock market. It's I just love it.
Yeah. It's like the new China or something.
Yeah. Just friendshoring.
Your thoughts, Ira, on
Well,
Mexico?
I've been everything that Kevin said, I've been on this, and as my blog readers, and I think we talked about it several times, Richard, that one of my favorite plays, of course, being the great trader that I am, I was good at accumulating, I just never stated, but the fact that Canadian Pacific bought Kansas Southern. Kansas Southern was the play. And I talked about it for 3 years, based even before COVID came about, because it went right down into the heartland of industrial Mexico, into the heartland of the US. And I was never understanding how Buffett didn't acquire it, because it was the one piece missing. And I would look at a railroad map, and look at the rail lines and see, and lo and behold, who buys it? Canadian Pacific. Now, the great trader that I am, I was accumulating $85 and $90. Of course, I was out by 145, 150. I go, wow, this is a great play, only to see it go to 325. But that's okay. But the story is right, and everything that Kevin says is right. And in context, China, and I've told this story, but people need to rehear it. January 1st, 1994, NAFTA begins. Now, NAFTA was meant for exactly what Kevin said, that the Mexican labor force was going to forever put pressure on US unions and workers to keep wages under control. And that's what his intention. We'd get all the energy and minerals we would need from the underpopulated Canadians and auto parts and everything else. And it would all come together. I mean, it's so easy to see it. But on January 1st, 1994, because China doesn't sleep, what does China do? On January 1st, 1994, devalues the yuan from 5.8 to 8.7. That's a 50% devaluation.
Did they do that on the day that NAFTA
On the
started?
day, January
I didn't know
1st.
that.
Yeah, 1994.
Okay.
You can fact check.
Oh,
me,
that's great. That's a great kind of tidbit, Ira.
you know, I was sitting in, I was a member of the Japan American Society when we had that discussion in real time. And Adlai Stevenson IV was the head of it. So
Oh, wow.
so I used to go there for lunches because I'd love to listen to the things that people talked about. I mean, I wasn't trading the renminbi, but I was certainly aware of what was going on. So that was the day that it happened, but by happenstance. Then by 1990, Christmas of 94, we get the so-called tequila crisis because you had this phenomenal flow of capital into Mexico, into Melquiadores and everything else. And then they said, uh-oh. And then 2 years later, of course, because the China, or 3 years later, no, 2 years later, 2.5 years later, you get the Asian contagion because of all that capacity that had also been built in Thailand, Malaysia, Vietnam, Indonesia, that got displaced by the Chinese. The Chinese now become the economic power using the yuan and the devaluation of the yuan. So they stole, as Kevin completely said, it was stolen right from under Mexico. And when that happened, I believe, I'm going to fact check myself, but I believe the peso was about in January of 94. Okay, it was, I can tell you right now, we don't guess, we get January 1st of 94, the peso was at 3.10 to the dollar.
Where was it at the end of the year?
Yes, that's it. See, that's a trader who has that question.
Okay.
January 95.
Yeah.
It closed at 5.75.
Wow.
Only to go up to 25 during the height of COVID, but certainly at the beginning of the year, we were still at 20.
Yeah.
You know, basically at 20. Now we're down to 17.8. So when you put Kevin's whole story together with the currency numbers, in fact, I had sat in 2012, 2013 with a couple of large industrialists in Chicago who played gin with my mentor and good friend, and they said, well, they want to talk to you about the peso because they were thinking about moving businesses to China. And I said, I wouldn't go that route. I would go to Mexico. They said, oh, Mexico is always a story. I said, those Melquiadores are empty. And at that time, I think the peso was, we were up to 12, 13 peso, but they were still paying 7 or 8% interest rates. So I said, the worst is you exchange dollars and you put them on deposit and you're going to earn a hell of a lot because we were at zero interest rates basically in the US. So, and I said, it's got to be a story that is going to happen. And as Kevin has said, that thunder and Chinese wages have gone up far faster than Mexico. You know, Mexico, the peso got beat up for several reasons because of the corruption, which, I mean, that's its biggest problem. But it hasn't run crazy inflation, by the way, over this period of time. So when you really think about it as a potential industrial powerhouse, it's there.
Yeah. And are you aligned with, in your discussions with Louis Vincent gave, Kevin, are you aligned with his view, like on the emerging markets, Brazil, Argentina, Colombia, and maybe the Yellow Crescent, right, from Indonesia to Kazakhstan, and
I don't know as much. I broadly, I agree with him. I am a big Brazil fan. That's the one big market that I'll do. But in terms of the other littler ones, I don't have anything except for kind of a broad macro view that, yes, I do have the same feeling. Ultimately, I am a commodity bull. I think that the world has changed. I think that one of the worries that we have right now is that a lot of the stocks and that we've been rushing into have been things like tech and long duration assets. And I think that we're going to have inflation that is going to be stubborn. And ultimately it comes down to my belief that We tried from 1982 all the way to 2020. Every time that we had an economic slowdown, we tried to fix it with, or we did fix it with monetary policy solely. It was only monetary policy that we fixed it with. And so what we were doing was we were stacking more and more debt on top of it. We were trying to encourage every time the market or the economy ran into some trouble, we lowered rates and tried to get people to borrow more and spend more. And eventually we hit a point in the great financial crisis where we couldn't actually encourage people to borrow anymore. And we had to do the extraordinary monetary stuff. And eventually we saw absolute stupidity occur in Europe with negative rates and a little bit of that in Japan. And what happened in 2020 was that there was a shift. And I look at it as a 1982 moment in reverse. In 1982, people thought that inflation could never come, it could never get destroyed, and that there was no way that we were ever going to stop it. Ira talked about Dr. Kaufman. Well, Dr. Kaufman was actually famous for his belief that inflation was going to run high and it was going to be very, destabilizing for many years. And what happened was Paul Volcker, slashed the inflation, and we've been in this secular decline. And in doing so, we've kind of gotten used to this idea that we only deal with monetary. And then we got to the point where it became ineffective. It became neutered. And what we did then in 2020 was we rediscovered fiscal policy. And when we rediscovered fiscal policy, we, it's easy to laugh about now and say, oh, it was so obvious inflation was going to come. I've been in an inflation bull for a long time. And people used to tell me, oh no, the 3 Ds, the demographics, the demographics, the amount of debt out there, and then the disinflation from technology is going to mean that we can never have inflation. I remember people telling me we could just never have inflation. I kept saying, no, if you have the political will, you can go and you can create inflation. And so I've long argued that if with the political will, we could do it, and it ended up taking a form of MMT and, something like that. But the long and short of it is that I believe that once we have opened this genie towards fiscal stimulus, it's going to be very difficult to put it back. Meaning that we will, at the next time the economy runs into trouble, we will spend again. And we will continue to do that. And I think for a variety of different reasons, and then combined with the deglobalization that we talked about, there's a lot of reasons that I think that inflation is going to be stubborn. And I think inflation is here. And that's one of the interesting things that I think is occurring right now. If we were going to talk about like a little bit shorter term oriented stuff, is that I'm kind of amazed at how much the market has kind of assumed we're going to go back to the 2010 to 2020 period, which is what we're getting right now. People, I hear them talk about AI and they talk about how disinflation is coming back. I see them rushing into bonds and doing it. It's like they think we're going back to that. And I'm going to take the other side of that. And I'm going to say, no, I think that when you look back, this will be the year or the decade of stubborn inflation, and you want to own different things. So part of that is kind of owning commodities and other kind of value stocks and not long duration assets.
Absolutely. Yeah. And your thoughts, Ira?
Oh my God. I mean, so this is such a great conversation because I always ask, and Kevin answers the question, but every morning I wake up, I go, who the hell would be buying long-term duration in the US? That's my first question. And then when Silicon Valley, of course, came, I said, it's not that anybody's buying, nobody's selling, because you've got these banks and you got the Fed, and the Fed doesn't hedge their balance sheet. So you're missing a lot of high quality hedgers who would have helped in pushing the market into a better situation. It explains really, to me, why the curve stays so inverted. And it's an interesting curve because while the 210 is still inverted, because everybody, if you follow the Fed, if you listen to Chris Waller, if you listen to this person, if you listen to that person, it's the easy trade to make until it wasn't, of course, once the banks started to shake a little bit. And Peter Bookvar and I had that discussion. The last thing you want to be short when banks are becoming the issue is shorter term treasury debt. And you saw what happened, and they got killed. The hedge, but they're back at it, and they're all pushing it because the Fed is talking hawkish. It's the easiest trade to make. but I'm with Kevin. When you're the global reserve currency, you have a great fiduciary responsibility. And that fiduciary responsibility is not only monetary, but certainly fiscal. When Volcker did what Volcker did, and we were crying, believe me, I'm old enough, and I was already working. When the debt to GDP level in the US was 39%, people were screaming about it. 39%. As I say, Volcker, well, I see Kevin is frozen again.
Yeah, just continue. All right, yeah, that's okay.
Okay, so Volcker could not do that with the huge debt load, and so I listen to Kevin, and he solidifies my view. Why should I don't want it to extend duration. I don't want to extend duration, and and when we talked with Mike Every, he's bullish the dollar because he has a different view, and he's smart enough that I have to stop and think about why do I want to be bearish the dollar? And my bearishness on the dollar, because I've lived through times when interest rates are 8%, and if inflation is 8%, that's a zero real yield. And whether I want to own your currency or not is dependent upon what policies you're putting in place. If the policy, I joke, unfortunately, yes, the US government policy should be directed at being a global fiduciary. They got the douche right, but they're missing the rest of it. I can't help I came from the trading floor. It's just my personality. So, but I go, why would I want to buy? Yeah, certain dollar assets I'll love. And if the dollar goes low enough, there will be US multinationals who will then attach, and I'll start thinking about them in a more positive light. But we got a lot of work to do here. And, we talked a bit, and, Kevin, I don't know how much you paid attention to, I'm going to bet you have a lot, to Jake Sullivan's speech from Brookings.
Yeah.
Right? That's a major, but as I keep coming back to it, and I think it's a major policy speech, and I'll call it the Biden doctrine, and it's not. And in essence, at least they're paying attention to the middle class that Donald Trump did so well with, and going, we got to find some policy, and they're going to try to do it with green job. I got it. It works, except the world is not 1948.
Right.
And where that was a way in 1960, because some people compare it to John F. Kennedy speech on Sputnik, and I'm old enough to actually remember that. This is not going to be as easy. And you saw it today. The FT had that article, the CEO of Siemens came out, and he's not leaving China so fast.
Oh.
In fact, he's pushing back against it. And then NVIDIA, the CEO from NVIDIA said, well, we need China's chips, that it could really be disruptive. Mm-hmm. So this is not going to be as easy. I'm just joining the US camp, because what are you going to give me? Bretton Woods, when Bretton Woods was put into place, it was done in conjunction with the Marshall Plan to lift the destroyed economies of the world and keep them out of the Soviet orbit.
Mm-hmm. Yeah.
This is...
Marco Popich from Clock Tower Research has been talking about that, about how the U.S. is able to dictate that people, you're not allowed to, trade with China anymore. And it's going to be more difficult and a little bit more stick handling than people fear.
Yeah, I think he's on. As we talked quite a bit with Mike every the other day, and people are going to recall it to me, but you know what? It becomes, the world's just not going to get into line. And you know what? Are you going to go back to tariffs to keep out people who don't adhere to what your policy is? This is not going to be easy, and you don't have the currency give like you had then. Right. And Japan, I think, is manipulating the system to its benefit, and I can't blame them. It's, hey, if they're going to allow me to do this, maybe at the benefit to do more movement out of China, because from a Machiavellian way, that would make, pretty good sense, but I'm with you. I sit and I scratch my head. I go, really? I want to buy, do I want to buy, what's my, on a US 10-year, what am I looking at? 3.75? I'm sorry, it doesn't do it for me.
Yeah.
Yeah, just so much to discuss. I think if we can continue a discussion for another round sometime, but just your final thoughts, Kevin, and also how can our listeners and viewers learn more about your work?
Well, thank you for having me. It's been just an absolute pleasure to be with you guys and chat with Ira. And I would love to be on anytime because I've really enjoyed this. Love hearing the stories.
Yep.
Someone who's actually been there and all the times with 87 and telling me these great stories. If people are interested in learning more about my work, you can go and check me out at themacrotourist.com.
Yep.
And you can go check out my Substack. And if you send me an email, kevin@themacrotourist.com, I'm happy to send you off some samples.
Cool. Great. And Ira?
You got to find me at FRA. I really haven't been writing much, and I'm trying to get this out there more and more. I think these podcasts have become so important for you can disagree or not agree. The more you disagree, the greater the benefit is for you, because then it may ask you why you are disagreeing, and it will keep you out of maybe
discussion,
some silly investments. But now that I know that Kevin has been following Buffett into the Japanese trading companies, so when I come to Toronto, he's paying for dinner.
Okay.
Anytime. Thanks for having me on, guys.
This is great. Thanks, Kevin.
Thank you so much, Kevin and Ira. Thank you.
Yep.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.